Nilesh Shah, the founder of Envision Capital. Nilesh, thanks so much for taking the time and speaking to us this morning, and good morning to you. We're speaking a day after there is this conversation that seems to be emerging, not in our market, but in the US market, about rotation out of artificial intelligence companies and into maybe consumer staples, even IT services companies or thereabouts. And the question, therefore, is: do we see a rotation out of the US as well and back into India? We've seen FIs selling consistently over the course of the last several weeks.
Oh, absolutely. I'm not too sure about rotation out of US equities or out of developed markets, but clearly I think the case for India is getting stronger. Emerging markets have been underperforming for a very, very long time. It's not just about the last 1 year, or probably it's a story of the last decade as well. But clearly believe that the era for emerging markets is now arriving. And emerging markets are expected to have a very, very strong outperformance going forward. And within that, India, on which foreign investors have been so underweight and have been net sellers for the last few years, I clearly believe that a change in stance could kind of be around the corner, given the kind of various developments that are happening. And based on that, I expect India to kind of get into a very, very strong mode of outperformance.
Nilesh, good morning. Neeraj here. And what is the linchpin of this outperformance? Is it earnings wherein the first quarter was slightly better than maybe what people anticipated, and does it set the stage for higher numbers? Or is it a slew of reforms that the government and the monetary policy committee have taken which drives growth and subsequently ushers in earnings?
A bunch of things, Neeraj. I mean, firstly, I clearly believe that something which has been less celebrated over the years is essentially the inflation targeting and the inflation management. And I have never seen India's inflation levels so low, and especially the inflation differential between, say, India and the developed world has narrowed down quite significantly. And to me, that's essentially a very, very long catalyst, a very strong trigger. So that's first. Second is the current developments that we are seeing on the tariff front, I think is definitely basically going to not just nudge, but push our policymakers into kind of taking some really more aggressive, more bold measures, which is essentially going to further drive growth. So I think that's the second big thing, which I think is going to be a very, very key catalyst. So I think a combination of these two strong developments, one on the monetary side and the other on the fiscal and on the rest of the other initiatives, I think are going to create very, very strong tailwinds for India and ensure that we not just sustain at maybe the 6.5% growth rate, but we probably nudge well past 7% and sustain there. I think that essentially is something which probably is getting overlooked by international investors and foreign investors in the current environment.
Right. Nilesh, good morning. Hiral this side. So with all of this said and done, what is the return expectation that an investor should keep? Because you've always been of the opinion that the investors need to moderate their return expectations. So what should that realistic expectation be for the next 1.5 year? And where should they look at in terms of investments?
So clearly, I mean, over the very long term, the returns on, say, the Nifty have been around more like in a band of 10 to 14%, depending upon what you take as your base. So it really depends on that. But the broad band has been 10 to 15%, which is pretty much well above what a fixed income product offers you or what a bank deposit offers you. So I probably think that that's a very kind of a reasonable set of expectations. Now, on top of that, you could have alpha being generated based on some of your thematic calls, sectoral calls, or even based on the stock picking that one does. So that I would probably think is basically a kind of a fair expectation to have. Though it's obviously very difficult to really pinpoint a specific expectation for just a year and a half. But I think over a 3 to 5 year kind of rolling basis, that's a kind of fair expectation to have.
Okay, so I want to get your sense, and Nilesh, I've completely on board with what you're saying about the uptick in GDP that will take place. But there are some arguments that have said that perhaps that increase in consumption may not be as imminent as some might think. We might have to wait for some time to get this. And of course, there will be a diverse set of opinions on this, and no one can predict it exactly. But do you think that in the worst case scenario, it will take about a year, or do you think that it'll definitely be faster than that?
Well, it's reasonable to kind of peg in a 1 year kind of an outlook by which consumption comes in with a bang. It's a separate kind of topic in terms of what within the consumption basket starts to fire and fire more. Clearly believe that areas like consumer staples are relatively mature categories, the basic consumer staples. And it's more going to be the aspirational stuff, which essentially is going to basically witness much, much stronger growth. That's pretty much been the story over the last 3 to 4 years. And I don't see that to be anything different, because that's more a function of something very structural happening, that as we cross certain per capita income levels, you tend to basically change what you consume. So I think what's going to really fire within the consumption space are categories where there's potential for penetration and there's potential for premiumization. So it's a combination of both penetration and premiumization, which is going to basically drive growth. In the very short term, it's going to be a combination of these various monetary and fiscal measures, like lower interest rates, the expected cut on GST, and the hike in tax exemption limits for the middle class, which is going to drive consumption. But over the very long term, it's going to be rising incomes, rising aspirations, and rising affordability, which is going to essentially create structural tailwinds for the consumption pack to kind of keep growing. So clearly, from a very medium to long-term perspective, consumption will remain an extremely attractive investment opportunity for investors.
So Nilesh, let's kind of narrow it down a bit. So because consumption is so wide, right? I mean, when you think of consumption, do you think of discretionary, non-discretionary? If it's non-discretionary, I mean, that bucket is also very wide and various ways to play it, right? How, and also, is the government move leading you to make that call right now? Because consumption has always been there, right? So is the government move recently because of GST otherwise, and the RBI moves which are making you do that? And therefore, within the bucket, what is it that you will kind of do your pecking order as 1, 2, 3?
Well, some of the recent initiatives of both the government, the RBI, and the policy makers have been supportive of consumption. And to that extent, they basically are creating a floor and a cushion to drive consumption. So I think that's basically policy measures at the first level. But I still believe that it is rising affordability, rising aspirations, which is going to drive consumption. And within that, what we like, I think it's a combination of both discretionary and non-discretionary. Clearly, I think demand for homes, demand for consumer appliances, I think should witness a very, very strong impetus. It's just a question of what you play within that. There are different ways to kind of do it. One is, of course, is to really buy into people who make these products. The other is to essentially buy into businesses which sell these products, which typically are platforms. And these platforms could be digital online platforms. These could essentially be offline stores-led platforms. That to me is a more attractive kind of a proposition versus the guys who make these products. And lastly is the guys who fund the acquisition or the buying of these products. So in the case of homes, I clearly believe that the affordable home financiers are a better bet to play on real estate versus actually just owning pure home developers. So I think there's a variety of choice. It's going to be between discretionary and non-discretionary. And within that, the big question is, do you buy the product companies, do you buy the platform companies, and do you buy the financiers? I think in the context in which we are today, I clearly believe that platforms and the financiers are a better way to play the consumption basket versus pure product companies.
better way. That's interesting. Your Swiggy itself is seeing smart gains in today's session. Paytm also trading in the positive. Nilesh, when it comes to defense, you've categorically always maintained it's a long-term sector. Buy on dips should be the strategy for this one. Taking into consideration the kind of performance defense has given right now, it's been one of the laggards, major downtick in terms of companies. Do you think valuations do support the current juncture, and would you say this would be a sector one should start looking at now?
Absolutely. I mean, defense is again an absolutely long-term structural opportunity that investors have. It's driven by two things. One is basically the drive towards indigenization or import substitution or building self-reliance and the whole Atmanirbharta kind of drive, which essentially is there. So clearly that's one. And two is, of course, now a lot of countries globally are looking at essentially trying to kind of have their own spending on defense. I think Europe has gone on record to basically, the European Union has gone on record to say that defense spending is going to kind of be significantly higher, which creates export-led opportunities for Indian defense companies. So clearly believe that defense is one of the most attractive investment opportunities. The fact that the space has pretty much kind of has been in a consolidation or a corrective phase for maybe a few quarters now. It has had bouts of ups and downs, but it's been relatively in a consolidation phase. I think the best way to really look at it is to look at which of these companies have the capabilities and which companies have a very strong growth pipeline from, say, a 5-year perspective, and then see whether they are attractive enough. So I think if one is looking at defense in the very short term, given that it's largely a B2G business, an order-driven business, it's going to be very, very difficult to take a very short-term call. The best way to really look at this is to look at a 3 to 5 year horizon, initiate positions in the ones you like, the companies you like, and obviously if market volatility offers you even a better entry opportunity, that would be a great time to load up on the pack.
Got it. Nilesh, absolute pleasure having you on the show as always, and great speaking with you.